Happy Sunday, everybody. I've been doing some backtests lately. You'll imagine that. I saw a tweet on X today, and it got me back in the mood to backtest. Anyway, I made a whole video about it. Hope you guys enjoy it. Stick around. We'll get right into the middle of it. And the conclusion might surprise you. So hang around till the end also. All right. All right. The name of the study is the cost of overhedging. 3 stages of ULTY, or SLTY, ULTY strategy. And I have an infographic that goes along with this. I'll share it with you. But this is kind of a rehash of a study I've already done, showing the return versus risk using different amounts of a positive high yield ETF with an ETF than inverse one. I was using ULTY and YQQQ in this study. You could also do Misty and Winter. You could do Tesla and Crash. It's the numbers are very similar. I've done all of them before, but let's just start with this. We'll come back to that in a second. So the tweet I was talking about was somebody saying that they're going to do a 50-50 allocation. And at first I was thinking, oh, that's a bad idea, or I've already looked at the math on that. But today I went back and I tested it and I gave it a fresh look. So like I say, stick around to the end. But yeah, in my original post, the 50-50, and it's still true today, gives up too much upside because of the thing about markets always going up. And the 90-10 portfolio still gives you plenty of upside and cuts your drawdown a little bit. In other words, 90% ALTY and 10% YQQQ, which is inverse NASDAQ. It's a really good hedge for ULTY. Now, will it be as good of a hedge as SLTY? I don't know. Hopefully not. I think SLTY is even going to be a better hedge and going to pay a higher yield. But YQQQ, I think, is a good proxy for understanding the way that the risk and reward switch. So when you get down to an 80-20 and you look at a back test on 80% ULTY and 20% YQQQ, you still did really well at 19% return. That still beat the SPY's return over the same time frame. And you had a 13% max drawdown. Now the SPY's max drawdown was 7.3 or something, if I remember. But anyway, so it was a little more dangerous than the SPY, but you still had great return and you got income on both sides. YQQQ pays a nice income, and of course ULTY pays a nice income. Anyway, so and when you get down to the 50-50 level, you're just giving up a lot of upside. But to be fair, I mean, you do have a tiny max drawdown, and you have a less of a max drawdown than SPY does. So when you do 50-50, it's almost like a bond, or it's almost like a 60-40 allocation. I mean, it has less risk in the same sense a bond or a 60-40 does. But anyway, the 50-50 allocation does what the Twitter poster suggested. It provides a lot of downside protection. Yeah, it won't cancel out the downside by any means, but it does a good job providing protection. For me, I think I'm into the 90-10 and the 80-20 during most markets, because markets usually go up. Occasionally, when we get under the 200-day moving average, the bear market defense, which would be 70-30, and I've done that in real life, and it helped. And it was when we were under the 200-day. I did it in late March and kept it on until the coast was clear, and it really helped, the 70-30 allocation. And I used YQQQ. Of course, SLTY wasn't around, but man, I would have loved to use SLTY. I'm excited about it coming out. So like I say, I think this, in my last study, found that 50-50 went too far, too big of an opportunity cost. You had 6.3, you underperformed by 6.3%. Or actually, no, I think you underperformed by 9.51%. I'm trying to remember back to the study. It's not that important. At a 50-50 portfolio, and this goes back more than a year, so we have a little bit of data, not a whole lot, but the 90-10 portfolio still made 23% return. 80-20 still made nearly 20% return. 50-50, you left a lot of upside on the table. You just returned 6%. However, your max drawdown was less than any of these other allocations and less than just holding the SPY. So, I mean, it depends on what you're looking for. I'll put links to that in here. But today we're going to go over, I guess, the fourth stage of ULTY and SLTY hedging. Today, though, I wanted to check out Portfolio Visualizer. Let's look at stage 4 of hedging. So here's what I did. What I did is we're looking at some just aggressive hedging, trying to turn ULTY and SLTY into like a bond, where it does just basically have no risk or as little risk as we can get away with. So there's different ways you can do it. You could use the beta of both of them, and you can try to make the portfolio beta neutral. And you can also try to make the portfolio delta neutral or market neutral. But anyway, so I did some math, and it's hard to get it. I mean, market neutral, but going for market neutral, I found that 65-35 is I think about as close as you can get. But it's hard to tell. Like I say, it's path dependent and everything. But I wanted to test that against a couple of other ideas. Okay, so the first idea is 65-35. That's super conservative because you still have plenty of ULTY, 65%, but you have 35% of the inverse. This would have that. I mean, and just doing this all the time and systematically. Now that over the test period, you underperformed the benchmark, which is the SPY, but not by much. Standard deviation was 13%. That's the same standard deviation as the SPY. So you pretty much, or that's what I was trying to do with 65-35. I'm trying to set this to be as dangerous as the SPY, standard deviation. So is a good measure of volatility. So you match the SPY. So doing 65-35, you match the SPY. You underperformed by a little bit, but you still did all right. Drawdown was 7.3. The SPY's drawdown was 9.3. The SPY still had less drawdown over this time frame, but not by much. That pretty much gives you a market. Let's just call it a market volatility, the 65-35, and that's with YQQQ. But I imagine it's going to be similar with SLTY, just because of the fact there's no free money. SLTY is going to have more yield, so it'll probably have a little bit less NAV, but I would think the total return would be close enough, especially, and we're just looking for it to offset ULTYs. And really, SLTY might even do a little bit better job offsetting it, but they're just going to give you more of your yield in the form of distribution, more of your return in the form of distribution compared to YQQQ. But I think this will be close. And if not, this makes a pretty good case for using these two. I mean, it's the same volatility as the market. That's pretty good. So anyway, but then I decided, well, wonder if a person went 50-50 ULTY, but instead of using SLTY, wonder if they used something like T-Oak. Now you remember Greg from Twin Oak was on my show for an hour, and this T-Oak, they use box spreads, which is a way of using options to extract the time value from the options, but to be totally market neutral. And that literally like a short term, like a 3-month T-bill. I mean, 6 month, like a short term government money. Anyway, now look at this. Doing this way, you got 16.2% total return. So you beat the SPY with the same standard deviation as the SPY and basically the same drawdown. So let's watch. We can look at them all three here. See this Vanguard 500 investor? That's the SPY basically. I could literally make it the SPY, but this is close enough for a benchmark. It's just a S&P 500 total return fund from Vanguard. So, but if you look, Portfolio 3, which was the 50-50 allocation, beat the beat the SPY by quite a bit, 16-13. Standard deviation was basically the same. SPY's 13, this is 12.9. We'll call that a tie. But then the drawdown was a little bit higher with the 50-50 allocation, but using that 50%, TO really stables things out here. Now look at this. Here's the best news. The standard deviation or the Sharpe ratio was better. It beat buy and hold on the Sharpe ratio. That's really good. This got a 1, and just holding the Vanguard gets it 0.78. And also on the Sortino ratio, this one. So this 50-50 allocation with 50% ALTI and the rest in TO, which is box spreads, basically, if you know what box spreads are. There are other funds out there that do those. I like Greg, and he was on our show, and I think TO would make a great combination. Let's kind of show you what that looks like. So see, TO is just the same as synthetically short-term T-bills. And so, so ALTI will go up and it'll go down, but having 50-50, this will even it out. And you don't get any income from TO, so you have to make do on this paltry $7.25 you get from ALTI. That's what, about 75-80%. It's about what it's on pace to pay. And this is over the past year, So think about that. ULTY is giving you paid out, it looks like about 75% distribution. And based on the initial investment, and returned about 13% total return. I mean, that's not bad. But anyway, you would have to make, if you did a 50-50 allocation, instead of making 75%, you'd be making about 37.5. But you get $7.25. Well, you'd do a 50-50 portfolio. It wouldn't be shares, it would be dollars. So anyway, but I think that's really interesting. That actually surprised me a little bit how well this did. That basically portfolio 3, is just like portfolio 1, super safe. It's just same standard deviation as portfolio 1, but unlike portfolio 1, it makes more money. So using ALTI and SLTY against each other, just in this time frame, they canceled each other out, which is good in a lot of good ways. It lowered the standard deviation to be the same as the market. So it gives you market volatility, but that 35% SLTY, I guess what I'm trying to say, holds you back too much during bull markets. Well, if you want to hedge it by going 50% ALTI and 50% TO, or one of the other, there's several good funds out there that do the same strategy. That's in pick whichever one you want. I'm going to use TO just because I don't know. I mean, I would research it. Maybe we need to have a comparison on all those types of funds, all the box spread funds. That actually might be fun. But anyway, what I'm saying is you could use your own judgment. A guy could also use cash. I mean, you could also use cash. Now, let me show you portfolio B. I had to explain portfolio C first. So portfolio C is basically, it almost is like 50% cash, but it's better than cash because it's a T-bill. So, but portfolio 3, now this is for, or portfolio 2, this is for advanced folks, but I wanted to see if I could go one level further. I haven't given up on SLTY yet. So portfolio 2 is, because 50-50 would work well. Obviously, the box spread and ALTI together works well. So I was thinking to myself, wonder if you basically did the same thing, did a 50-50 allocation of the box spread strategy, i.e. TO, some type of T-bill strategy, short-term options, in a market neutral type option environment. So you don't worry about the NAV. The NAV of that one's always going to be there. And but you could do something like 50% ALTI and then 10% YQQQ. This is almost like return stacking, but it doesn't use leverage. So a 50-10 allocation gives you, that's about equal to about an 85-15. So that gives you a little bit of a little bit of the inverse fund to kind of, I mean, it would be 85. It would be 85-15 if this was a full allocation, but it isn't. It's actually 50-10. I was just, but only on 60% of your portfolio, because the other 40%, as if that makes sense, would be in TOC. So you would have a little bit less TOC, but I was trying to see if you could squeeze a little bit more safety and return. So now let's go check portfolio 2 against portfolio 3. Now remember, portfolio 3 is just a 50-50 allocation. It doesn't even use any SLTY. Portfolio 2 just sneaks in 10% SLTY, which is actually, like I say, it's equivalent to an 80-20, but only on 60% of your portfolio. All right. Well, so compared, it doesn't get quite as much return as portfolio 3, where it's just the 50-50. I mean, once again, because even that little 10% of the inverse would, hold you back. Now, still, though, this still beats the benchmark. So this beats the Vanguard 500. And look at this. The standard deviation is lower, but because of that SLTY, this is even safer. Your standard deviation is lower than just the Vanguard 500, and your drawdown matches the Vanguard 500. I mean, this is it right here. So this one right here is pretty much as close as you can get to just being 100% invested in the SPY or the VU, total market index, total return, whatever. So that's the allocation right there for sophisticated people. If you insist on using SLTY, and it's with the caveat that to the extent the YQQQ is a good proxy for SLTY, but you watch, I bet it will be. YQQQ's done a great job. It does exactly what it's supposed to, and it's doing the same basic strategy. SLTY hopefully will benefit even more than YQQQ because they're trying to pick extra bad stocks and extra volatile. But I think at the least it should do as well as YQQQ is what I'm trying to say. So, so it's somewhat of a proxy. But I really like the idea. I mean, it's simple just to go 50-50 and look. And I mean, 50-50 does pretty well also. But anyway, so we have choices out there. So let's, but I was kind of a little bit surprised about that. I mean, to tell you the truth, you have to survive on 35-40% yield. And I didn't even show that. Let's look at that. This is on $100,000. So YQQQ came out in September of last year. So we can go from September of last year to up to July, up to a month ago this year. So we could look at the income on $100,000. Portfolio 1, that's the advantage of portfolio 1. And portfolio 1 was 65-35. Okay, but in any event, portfolio 1 was me trying to get market neutral with just ALTY and YQQQ. And that got pretty close. But it got a lot of yield. I mean, so that's not a bad option. Door number 1's not a bad option. 65-35. I mean, not for me because I'm a perma bull. I mean, I'm going to be 90-10 or 80-20. But if you're just worried about trying to get risk-adjusted reward and with a lot of safety, I mean, you could do worse than 65-35 over this time frame. And this is just over the past 13 months. But it's been a pretty bullish past 13 months. So anyway. All right, so 65-35 gets new respect from me. Now, if you go 50-50, the thing is you're giving up income. Remember, this is from September last year to December. You got 17,000 income on 100,000, but that's not too bad because that's for about a third of a year. You would have, I mean, you would have got it's 50-50, so you get half of whatever ULTY's distribution is. So probably about 40%, 40-45%. So that's definitely respectable. Then this is from January of this year to a month ago to late July, and you've received 28,000, or I'm sorry, in the 50-50 portfolio. Well, let's look at the 65-35. In the 65-35, because you have all that SLTY, you don't have as well good of a risk-adjusted reward, but you do have better yield. Because when you use the box spread fund, you're giving up yield in return for safety. But in any event, yeah, you make a ton of income on the 65-35. You've made 38,000 this year, and the year's not even over with. You still have August, September, October, November, December. You still have 5 months left. So, and that's just on 100,000. And we would expect that though, because it's all in on high yield. So that's going to make, it looks like about 70 or 80,000 on 100,000. So that's actually, so there's nothing wrong with 65-35 if you need yield, but I'm going to say that the other two give you enough yield and more safety and more upside. Because the all that SQQQ that you hedge with, that 35% portion that you hedge with, is costing too much upside. At least it has been. So anyway, but I mean, I think I could get by either on $28,000 or $27,000, because that's going to be about 40,000, 40 or 45,000 at the rate that's going. And the advantage is, let's look again at the advantage. Well, we can look at the advantage several ways. You can look at drawdowns. So portfolio one's the 65-35. It was they're all 7 months on this one, but they were all underwater for 7 months, 1, 2, and 3. But look at the Vanguard 500. Now it was just underwater for 5 months, where those other ones in the same time period were underwater for 7 months. They took 2 months longer to get back above even. But then there was 2 drawdowns in the market that the hedged strategies didn't even have. There was a 2-month underwater period in December, probably November, December of 2024, the election, in other words. Well, no, and then there's another one in October and November. December and January, the hedge ones make sense there. As far as standard deviation goes and max drawdown, well, that shows you what each fund does individually. In YQQQ, it's -88. That means it's almost a perfect hedge for ULTY. And I bet you that SLTY will be very close to that same number. We'll see, though. We'll see. Okay, so let's, I thought you guys might like this also. This right here shows upside capture and downside capture. The last column is the SPY. Of course, it's 100, or it's Vanguard, whatever. Catches all the upside, catches all the downside. It's stock. That's all it is. So these allocations, as compared to that one, and 3's the 50-50 allocation, catches 96% upside, 72% downside. 2 is the wild one, where it's 50, 10, 40. But this one doesn't catch as much upside. It's only 85% upside, but also catches a little bit less downside because of that allocation of SLTY. And then this one is this one's the one that gets all the yield, the 65-35 yield buster allocation. Catches, it's between the two on upside, and it's relatively safe, but it does catch the most downside of any of them. But it has the highest yield and worst NAV performance. The over here, these had less. They're going to have a little bit less yield, about half the yield. And so that makes sense. Also, the yield basically is the risk. It's one way to look at the risk. Look at this, positive periods. That's what we were just talking about on the drawdown lengths. This one was only 6 out of 11 months positive. These were 8 out of 11. So, because you're somewhat hedged. Anyway, I'll share this study with you if you guys want it. And don't forget, cash is king. Another great hedging strategy is having cash on the sidelines. So, if you want to play salty 80-20, but you aren't sure about salty or whatever, just stay away from it. I get it. Just spend 80% of your money on ULTY that you would have otherwise spent, and keep the cash, or maybe go buy T-Oak or one of the other products like T-Oak with the 20%. But in other words, keep the other 20% on the market, and that's a hedge within itself, and that works fine too. And I like the idea of the 50-50 salty ULTY. But I think it sacrifices too much upside. And I think I showed you guys that pretty good. Remember, the goal of hedging isn't to eliminate all risk. It's to manage risk at a reasonable cost while still participating in market growth. Sometimes the best hedge is simply accepting the markets go up and they go down and position accordingly. So if you guys want to tell me what you're thinking about doing with SLTY and ULTY, I'm definitely going to use it probably in stage 1 or stage 2, 80-20 or maybe 85-15, something like that. Cautious, bullish but cautious, just kind of my usual stance. But if we get under the 200-day moving average and we get the term structure of the VIX goes into backwardation and stays there for a while, I mean, yeah, 70-30, maybe even 65-35. That 65-35 didn't look terrible. It didn't look terrible, but I think I showed you guys a few better options. If we really were worried about if you're really worried about the markets, you could also do the 50-50 and put it in, keep it at 50% in short-term T-bills, something like TO. Basically something like that, something that's totally market neutral, like a short-term bond. All right, guys. Well, thank you so much for being here. I hope you like this, and I hope you have a great evening. I'll talk to you soon.